Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 1, we covered the basics and benefits of municipal bonds. Now, let's dive into the risks and important factors you need to consider before making your investment. Let's get started. Risk and stability. Municipal bonds are widely known for their low risk and stability, which is why they attract conservative investors. Why are they safer? Because they're backed by government entities that typically have a reliable stream of income, whether from taxes or revenue from public services. General obligation bonds, in particular, are considered very secure, as they rely on the full taxing power of the issuing municipality. Even revenue bonds, though slightly riskier, still pull payments from consistent sources like toll roads, utilities, or hospitals. Historically, the default rate on municipal bonds is relatively low compared to corporate bonds, so investors can sleep a little easier. While all investments carry risk, municipal bonds tend to hold steady, even during economic downturns. For someone prioritizing capital preservation, they can act like a financial safety net while still generating periodic income. Portfolio diversification. Municipal bonds shine when it comes to diversification. They tend to behave differently from stocks or corporate bonds, which makes them an excellent addition to a well-rounded investment portfolio. Here's how they can help. Reduced volatility. Stocks can be unpredictable, fluctuating sharply based on market conditions. Municipal bonds, however, have more stable pricing patterns and aren't as closely tied to the ups and downs of the stock market. Steady cash flow. Since municipal bonds pay interest at regular intervals, they provide consistent income that can balance the riskier parts of your portfolio. Hedge against inflation. Certain types of municipal bonds, like inflation-protected bonds or those with variable interest rates, can act as a cushion when inflation rises. For institutional investors like pension funds or endowments, municipal bonds provide a reliable income source that aligns with long-term financial goals. For individual investors, they can supplement retirement funds, offset riskier stock picks, and create a more balanced investment strategy. By including municipal bonds in a portfolio, you're essentially adding a layer of stability and reliability. It's like having an anchor that keeps your financial goals grounded, even when other investments face stormy seas. Keep municipal bonds in mind as you evaluate your financial options. Their combination of tax efficiency, low risk, and diversification benefits make them a standout choice for many investors. Risks associated with municipal bonds. While municipal bonds are often seen as a safe investment choice, they're not completely without risks. Understanding these potential downsides can help you make informed decisions and avoid surprises down the road. Let's break down some of the key risks you should know about before investing. Credit risk and defaults. No investment is entirely risk-free, and this includes municipal bonds. Credit risk refers to the chance that the issuer might not be able to pay back the bond's interest or principal, leading to a default. While defaults on municipal bonds are relatively rare compared to other types of debt, they do happen. For example, if a city or county experiences financial trouble, such as falling tax revenues or poor budget management, it may struggle to fulfill its obligations to bondholders. Not all municipal bonds are created equal when it comes to creditworthiness, though. To gauge the risk, investors can look at credit ratings issued by agencies like Moody's, Fitch, and S&P Global. These ratings assign a grade to the bonds, ranging from the highest quality, AAA, to lower risk speculative grades. Here are a few tips. Stick to investment-grade bonds. Bonds rated BBB or higher are considered investment grade and generally have a much lower risk of default. Be cautious with lower-rated bonds. High-yield municipal bonds, also known as junk bonds, may offer higher returns, but they come with significantly more risk. Check the financial health of the issuer. Research the municipality's debt levels, revenue sources, and budget history. A city with a growing population and steady tax base will likely be in a stronger position than one facing economic decline. Remember, even bonds with high credit ratings aren't immune to downgrades if the financial situation of the issuer deteriorates. That's why keeping an eye on the creditworthiness of your bond investments is essential. Interest rate risk. Municipal bonds are also vulnerable to interest rate risk, the risk that rising interest rates will reduce the value of your bond. When interest rates go up, stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.